Hi, this is Tom Sedlak, General Manager at 33rd Company Property Management. Thanks so much for watching our video podcast. Today's topic is HOA and CIC accounting tips for board members. You know, homeowner associations and common interest communities have a fiduciary obligation to all of their constituency, which is basically all the members of your association, all the homeowners. And there are certain things that are really must-dos when it comes to HOA and CIC accounting. Probably the very first one that you have to decide is what you're going to do in terms of setting up your operating and your reserve accounts. And that's really very critical. In fact, the state of Minnesota requires that you have custodial trust accounts set up through a bank that is registered in the state of Minnesota, and that's a requirement for all HOAs. Once you do that, those custodial trust accounts, you're going to have one that's going to be designated as an operating account, and the second is going to be designated as a reserve account. Typically, money flows in and out of the operating account, which includes member dues coming in, any other cash receipts for any other income that the association has, and then all outflows from the operating account would include vendor checks for services rendered. Any of your lawn or landscaping contracts would obviously be paid through that operating account. Additionally, you'd want to make sure that your operating account also covers all your normal operating expenses. So any utility bills or any common trash bills or anything like that obviously would be paid for from your operating account. So the money coming in and going out typically is done through the association operating account. The reserve account, on the other hand, is the rainy day fund, basically for improvements and renovations. And you don't want money going in and out to external accounts in the reserve account. You only want money to go from the operating account to the reserve account when you're doing a monthly or annual reserve transfer to stock up your rainy day fund. And then conversely, when you actually do expend those funds on an improvement, the money goes from the reserve account back to the operating, and then you use that operating account to write a check to that vendor for that improvement that was done. That way your accounting is tight and your reserve account doesn't ever show external transfers which could violate state statute. So you want to make sure that you set your accounts up that way. Receipts. One of the common mistakes that HOAs and CIC communities face is they don't retain all of the receipts for their association so they can properly document their cash disbursements to vendors. So make sure that you keep your receipts, and also make sure that you keep any invoices, estimates, basically keep a good paper trail for all of the activities of the association so that you can not only properly do your taxes but also can justify correctly whether an expense was an operating expense, which is normally paid out of operating funds, or was a capital improvement or an improvement expense, which is paid using reserve funds. And that is a statutory requirement where you need to document and justify any transfers out of your reserve so that they are funneled for use specifically for those capital improvements or upgrades, which are improvements. So that's important to keep a good receipt trail. All too often we see HOAs or boards take, for instance, cash from their washing machine vendor proceeds, and all that change gets deposited into the bank, or sometimes they don't deposit in the bank, and it goes out to become a cash payment for some other need for the association. And of course then it becomes undocumented cash coming in, and you never want to get in a situation when you have undocumented cash or undocumented funds, because as I said, you are the fiduciary party, and you're responsible for the common property, including any income proceeds, cash proceeds, and you want to make sure that those are properly documented. So what you would do in that case is you would make sure that they're directly taken, they're counted by at least 2 board members so that they both sign and verify the amount of money that was taken out of the washing machine, for instance. And then they're deposited, and that receipt plus the signed certificate saying here's how much money we obtained is all kept on file. And then your record keeping is good and fully supports the money, and you won't have an issue with an audit, or you won't have an issue with a lawsuit from a fellow homeowner that thinks that the laundry money, for instance, is being used for other purposes. The last tip for the accounting tips for board members: cash or accrual. That's kind of an interesting question. A lot of people instantly say, I want to be a cash accounting system, and that works fine if you're a smaller association and your Proceeds are typically in the multi-$100,000 or less annual amount. But when you start to become a larger association, there actually are state statutes that require you to move on to an accrual system so that you can more accurately obtain the recurring cash flow and P&Ls for that association. Additionally, if your books or your management is being done directly by a CPA, there's a statutory obligation as well that a CPA must do your books in an accrual basis. So those are some things to think about. Hiring of property manager is always the best solution for the majority of homeowner associations. Even the smallest ones can get an accounting-only service that'll help them over the peaks and valleys of the accounting process, which can be daunting, and there's a lot of rules and regulations with regard to that. So next time you're looking for a nimble association, consider 33rd Company. We'd be happy to help. Thanks so much for listening. Have a great day.